Hello, Algo traders. Welcome to this video. We are going to be talking about dominating candlesticks. I call them DC. This video is not supposed to be the next in the tutorial series, but I decided to release this in response to the current price action on gold. On X, Twitter, the previous week, many users were taking shots at gold traders, asking why gold traders were not posting screenshots like they usually do, screenshots of trade, of payouts, and all. Then came last week and this week, accounts were just blowing up left and right, and there was so much pain on the timeline. And in all of this, I have just one question, and the question is, which entry signal did you use? Which entry signal did you use? This brings us to today's lesson, dominating candle. Before we proceed, the advantage of automation over discretionary trading is that you get to discover markets efficiencies and inefficiencies while backtesting. One of such is this dominating candle that I'm sharing with you now. To understand dominating candles, there are four modes of price delivery. We have the expansion, we have retracement, we have reversal, and consolidation. The expansion, the retracement, and the reversal, what they have in common is they travel to new highs or new lows, and they revisit old highs and old lows. But the consolidation doesn't do that. The consolidation is sometimes called the contraction. It doesn't. And uh, whenever you come across a tweet, a trader telling you, "Oh, I had great month of performance and one trading session, one day, one week ruined it all," a consolidation or a contraction is responsible for that action, and it's always hiding in plain sight. So why is this candlestick formation responsible for these losses? I'll explain to you. Most traders are breakout traders, trend following. All they need to do is to secure a good trade entry, place their stop loss above the entry, and ride the rest of the wave. The flaw to this strategy is it is determined by the probability of your breakout follow through. If there is a follow through to your breakouts, then you are going to ride the trend. But if there is no follow through to the breakouts, price is going to revisit your entry or probably uh, visit your stop loss. And we identify this. How do we identify this dominating candle? We identify it by a candle that closes and engulfs more than two candlesticks that closes after it is a dominating candle. When I say engulf, I mean two candlesticks have not closed after it. Let me show you examples. This is a dominating candle. You can see that since the close of this candle, every other candle until these two closed within its range. This is a dominating candle. Also, here on gold, this is a dominating candle. When price is stuck in the range of a dominating candle, it prints only corrective formation, sideways movement. This brings us to the Elliott wave theory. The first DC appeared on gold in the recent price action was established here on February 4. That is after two candlesticks failed to close outside the range of this candlestick. So we've drawn out uh, the range. Let's see what happens since then. Unselect this. So you can see we have it printing again and again. Let me change the color for this time frame to, let's say this. Okay, not visible, blue. You can see it keeps printing everywhere because price is fractal. So because it has appeared on the daily time frame, it infects every other time frame. One push, then a dominating candle. One push, then a dominating candle. One push. Okay, yeah, here it is. Okay, okay, we don't have that. And now, at the start of this week, a dominating candle printed. And the whole of the week had been in the range of that dominating candle until it broke out a few days ago, a few candlestick ago here. But upon breaking out, it was still in the range of another dominating candle, and then it stumbled. And after it stumbled, what did it do? It formed another range of dominating candle. If you go down to the H1, you see it's everywhere. One candle, everybody is in its range. This is H1. Let me use green. Let me use yellow. You see, it only gives one push after it prints. Only one push, then it continues. Only one push, only one push, only one push. Even today, you can see we are still stuck in the range. So it doesn't matter the time frame. Let's go to the 1 minute time frame. I know many gold traders love to experiment on the 1 minute. It keeps repeating itself. Dominating candle, it's everywhere. Why? Because price is consolidating. So now, as you can see, this dominating candle is everywhere. Why? Because it exists on the high time frame, so it just keeps going and going and going and going and going and printing everywhere on all time frames. So, uh, okay, let me show you something else before we move on. So, price moves in fives and threes on any charts. Based on Elliott wave, price moves in five waves. And let me clear all of this from the screen. Price moves in five waves and three waves. And one of the simple ways to identify a three wave is uh, their sideways movement. They only take time. They don't really produce any significant price movement. Here is a simple example of that. Open any chart, scroll anywhere on any chart, look for the high on your left and the low on your right, and draw a simple horizontal line. You are going to discover price comes back there always. I can do this all day. Okay, this is a downtrend, so this is low to high. For a uptrend, it's high to low. So this is a corrective wave. It doesn't produce any significant price movement. It only moves from side to side. A corrective wave does not produce any significant price movement. It only takes time and moves from side to side. Can you see? Can you see? Can you see? In fact, you can simply place pending orders once price breaks it because you know price is coming back. So let's come back to the current price action on gold. This is the high that was formed on January 30, the start of the dominating candle. The bearish price formed at 5597 over here. Okay, and since then we had a five-wave drop. You can see this yellow square is the start of the wave. This green square is the end of the wave. How many subwaves do we have in between? That's the yellow and the orange arrows. One, two, three, four, five. So we had a five wave down. Uh, when it comes to corrective waves, we have zigzags, they are 535s. We have flats, they are 335s. We have a triangle, they are 333. So for this correction to start with a five wave, it is a zigzag. So a zigzag five, after a five, you expect a three, then you expect another five. Back to our chart. So this is our five coming down. Let me zoom out. Can you see the tree? One, two, three. This is the tree up here. Okay. Uh, Here is a closer look. For the A, you can see we have five clear waves. Yes, this is the A. We have five clear waves. You can see wave two was a deep correction, simple. Wave four happened to be a complex correction. Then we have five. So you can see from this one, two, three, the yellow square formed here because it was an orthodox top. If you apply RSI to this, I'm sure you'd have a divergence in price. That's why it's signaled. Okay, so now coming down, you have three. One, two, three. Oh, someone says no, that you're not counting three, you're counting five. This is one, two, three, four, five. What did I tell you about sideways movement? You can see from this point down to this point, there is no price movement. It was only time that passed. It only went up, came back down, and came back to that exact point again. So this is a sideways movement. This is a tree. One, one, two, three, then one. So then five waves up. We start here. One, two, three, four, five. This is a diagonal. That is why you see that the wave A is larger than all of the other waves. I have it here, diagonals, diagonals. Okay. Triangles contain five overlapping waves subdivided into three. The ending diagonal there. Okay, here it is. An ending diagonal is a special type of wave that occupy the fifth wave position at times when the preceding move has gone too far too fast. A very small percentage appear in the wave C position of ABC formation. That very small percentage is what you're experiencing. In all cases, they have found a determination point of larger pattern indicating exhaustion of the larger movement. They take a wedge shape within two converging lines with each subwave including 135 subdividing into three which is otherwise a corrective phenomenon. Fifth wave, this is what I want you to pay attention to. Fifth wave of diagonal triangles often end in a throwover. A throwover is a brick wave of the trend line connecting points 1, 3, and 5. You have your throwover here. This is 1, 2, 3, 4. This is your throwover. When you draw your trend line, this is your throwover. Let me show you more. On rare occasion, the fifth subwave will fall short of the resistance line. A rising diagonal is bearish. A rising diagonal is bearish and is followed by a sharp decline retracing at least back to the level where it began and vice versa. Fifth wave extension, truncated fifth and ending diagonals all imply the same thing, dramatic reversal ahead. At some turning points, two of these phenomena have occurred together at different degree, compounding the violence of the next move. So you now ask yourself this question. This move that followed, this violent move, is this a market manipulation or not? It is not, because it came after an ending diagonal in the C wave. Okay, so now what comes afterward? Is this the start of a new bearish wave, a new one, two, three? Well, that is a possibility. It is also possible this is just the start of another complex correction because it's what price does. But if this is the start of the C wave, this is a complex correction here at wave 2. So just like we have here the law of alternation, this complex is here now, this dip would be here at 4. So we should expect price towards 4900, yeah, 4970, 50, 5000 before making the fifth wave. That is if this is the start of wave C. And if this is the fifth wave, this is this the 1, 2, 3, 4, 5 is just going to be wave 1 of 5. So that is that. Uh, Going further, why am I not trading this? If you can read all of this simply, why are you not trading this? The question is, I don't trade corrections. When price prints correction, it is my time off to go and relax and study the charts and build new strategies. Let me show you this. Here is a screenshot of a subscriber of mine. Check out the date, January 30. He was complaining in Spanish that the EA has not executed any trades. And I told him the framework stays out of markets when price is consolidating on the higher time frame. It is a trend follower. It stays out of choppy markets and executes only when there is an established trend. Oh, January 30, there was no consolidation yet. Really? Did you check your charts? Let me clear these lines off. Let's go to gold. Can you see if this if we have 2 months closing within the range of this, then you have a dominating candle on the monthly time frame. You can see it had existed before. Back to the weekly, we've been riding it for a while. In fact, this is a wave A, this is a wave B, this is a wave C. A possibility. This is a wave A, this is a wave B, this is a wave C. But as you can see on the weekly, you're already in a dominating candle, you were in a dominating candle, you were in a dominating candle. So when it comes to price action, you cannot force a trade. You need to understand what where price is going and what price wants to do. This is an account killer. Look at this. Look at this period on the weekly. During this week, it will blow your accounts. Meanwhile, just a couple of 3, 4, 5, 6 weeks after that, you'd have had the best uh, consecutive bull trades that you can have. So you need to pay attention to the dominating candlestick. The code for identifying the dominating candlestick, you see, I this is this here in my code. You can see if it exists on the monthly, if it exists on the weekly, if it exists on the H4, I have a code for it. Uh, I'm going to share that with you. Yes, this is the code for the dominating candle. So I'm going to post it on GitHub and attach the link to the bottom of this video. You can use it in your EA, refactor it to suit your own needs and add so you can avoid getting caught in the consolidation market. And if you still have further doubts about how disastrous the dominating candle can be, I'm going to refer you back to December 4, 2023. Yes, this is December 4, 2023. It was a new all-time high, and price printed a dominating candle on the daily time frame, which turned to a weekly. As you can see, it's turned to a weekly, and all through that period, it was a massacre. You can see spikes everywhere on every time frame. You go lower, same thing. One push, dominating candle, one push, dominating candle, one push, dominating candle, one push, dominating candle, one push, dominating. So it's not a new phenomenon. It had existed long and it would always continue to exist. So just add this code to your expert advisor and stay out of painful market moments like this that can wreak havoc on your trading accounts. So, if you have any questions, just drop a comment below the video and don't forget to like, share, and subscribe with your trader friends and learn how to build expert advisors. It's the shortest cut to profitability in your trading journey. Bye.